wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 225, and in this episode we're reviewing the performance of the financial markets during the 32nd week of 2026, and that is from Monday the 10th to Friday the 14th of August. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where consumer inflation data released on Wednesday showed prices were moderating across a range of goods and services, reducing the urgency for an imminent rate hike by the Federal Reserve. According to the Bureau of Labor Statistics, the Consumer Price Index showed a seasonally adjusted annual increase of 3.4% in the month of July, whilst core inflation, which excludes volatile food and energy prices, increased by 2.5%, and both readings were down by a 0.1 percentage point from June. Though inflation remains well above the Fed's 2% target rate, the moderation in the Consumer Price Index indicates that inflationary pressures are easing off, but still remain subject to volatile oil prices and the constantly changing conditions in the Middle East conflict. Staying stateside, the Treasury Department reported on Wednesday that the U.S. budget deficit soared to its highest monthly level in more than 5 years amid a surge in Medicare costs and as interest on the federal debt continued to weigh on the nation's fiscal position. In addition to the big single-month jump, the collective red ink across the first 10 months of the government's fiscal year rose to nearly $1.8 trillion and surpassed the same period in 2025. The shortfall in July totaled to $432.3 billion, and this was up some 48% from the same period a year ago, and was the largest monthly deficit since March 2021. Over to the Far East, where the Japanese yen has raised about half the gains from a historic US-Japan intervention less than 2 weeks ago, as the fundamental forces that have pressured the currency to multi-decade lows prove increasingly resilient against short-term intervention measures. Japan's currency is currently trading at over 159 yen per dollar after having strengthened to 155 from 163 in the days following the intervention. At the heart of the problem is the gap in returns between Japan and the United States, with Japanese borrowing costs at around 1%, still far below those in the United States, which are trending at around 3.5%, and this prompts investors to borrow cheaply in the yen and invest in higher-yielding assets, which is commonly known as the classic carry trade. The coordinated intervention between the US and Japan succeeded in reducing speculative excesses and raising the risk for traders betting against the yen, but it has not eliminated the underlying yield advantage that supports the US dollar. On Wall Street last week, the S&P 500 slid on Friday after a record-setting session, though the benchmark still notched its third consecutive weekly advance. This has been a record-setting week for the S&P 500, with the index on Thursday crossing above 7,800 for the first time after hitting an intraday all-time high of 7,816. The positive performance in stocks was attributed to solid earnings, and according to FactSet, more than 50% of S&P 500 companies have posted year-on-year earnings growth during the second quarter of this year. For the week, the broad market S&P 500 advanced by 0.4% to end the week at 7,785, whilst the tech-heavy Nasdaq Composite recorded its third weekly gain in a row and was up by 0.1% for the week before closing at 26,729. Meanwhile, the 30-stock Dow Jones Industrial Average was down by 0.6% on a weekly basis before settling at 53,732. In the government bond market, the yield on the 10-year U.S. Treasury bond rose on Friday following the release of the latest consumer inflation data, which showed prices were moderating, and as the Trump administration said its naval blockade of Iranian ports could continue indefinitely. Consumer inflation data released early in the week showed prices were moderating, reducing the urgency for a rate hike by the Federal Reserve. The yield on the 2-year Treasury note, which more closely tracks short-term Federal Reserve interest rate policy, added 3 basis points to close at 4.17%, whilst the yield on the 10-year Treasury bond, which is a key benchmark for U.S. government borrowing, this rose more than 5 basis points to settle at 4.69%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices rose on Friday after the U.S. said its naval blockade of Iranian ports could continue indefinitely, reigniting concerns over energy flows through the critical Strait of Hormuz. Meanwhile, the International Energy Agency said on Wednesday that global oil demand is expected to fall further than previously expected this year amid the ongoing squeeze around the Strait of Hormuz. Both benchmarks advanced more than 5% during the week, with the international benchmark Brent crude rising by 1.7% on Friday to close at $88.52 per barrel, whilst the U.S. benchmark West Texas Intermediate crude gained by 1.4% before settling at $82.40 per barrel. In the precious metals market, the price of gold rose on Friday and was headed for a weekly gain, supported by a weaker dollar after U.S. inflation data showed signs of moderating, suggesting that the Fed will stay put at its next policy meeting in September. Gold is drawing support from an unexpected decline in non-farm payrolls in the month of July and a moderation in consumer inflation this past week. This has significantly lowered the expectations of a rate hike in September, with markets projecting that the Fed will hold its policy rate steady. According to the CMA's Fed Watch tool, markets are currently pricing in a 31% chance for a September rate hike, and this is down from about 55% the previous week. Bullion was up by around 1% for the week, with the price of spot gold gaining by 0.7% on Friday before closing at $4,379 per ounce. Moving over to the African financial markets, where Nigerian billionaire Aliko Dangote has announced plans to finance his proposed Lamu oil refinery using debt of around $11.2 billion, which is equivalent to 1.4 trillion Kenya shillings. Dangote outlined a financing structure of 70% debt and 30% equity for the project, which is now estimated to cost $16 billion, which was revised downwards from an earlier figure of $17 billion. The refinery is projected to be completed within 4 years, with construction expected to commence by October this year. Dangote warned that the refinery will need government protection from cheap imported fuel in order to remain commercially viable. He said the refinery would struggle to compete with refined products from countries such as Russia and India unless Kenya puts measures in place to shield the facility from what he described as dumping. In related news, the Dangote Petroleum Refinery has submitted an application for a $5 billion IPO to Nigeria's Securities and Exchange Commission. The IPO is planned for October this year and is designed to allow retail investors to participate and share in the company's growth. And over to TZ, where Tanzania's central bank, that is the Bank of Tanzania, announced it had relaxed its foreign exchange rules to allow all overseas investors to buy government-issued treasury bills and bonds. The central bank said in a statement on Thursday, the 6th of August, that the move was aimed at deepening domestic financial markets and promoting Tanzania as an investment destination. Previously, only residents of the East African Community, the South African Development Community, and the Tanzanian diaspora could participate in the government securities market. We now change scene to the Kenyan financial markets, and we start by looking at the central bank's monetary policy decision, where the central bank's monetary policy committee held its policy meeting on Tuesday, the 11th of August, and made the following observations about the global as well as the domestic markets. Global growth is projected to moderate to 3% in 2026, down from 3.5% in 2025, mainly due to high energy prices as a result of the ongoing conflict in the Middle East. Global inflation is expected to increase to 4.7% in 2026, up from 4.1% in 2025, and this is on account of higher energy prices and transport costs. The Kenyan economy grew by 5.3% in the first quarter of 2026 compared to 4.9% in the first quarter of 2025, reflecting a broad-based growth across all sectors of the economy. Kenya's overall inflation remained within the target range in July 2026 and was broadly stable at 6.5% compared to 6.4% in June. The banking sector remains stable and resilient with strong liquidity and capital adequacy ratios, with the ratio of gross non-performing loans standing at 14.6% in July 2026, and this was down from 17.6% in August 2025. Meanwhile, growth in commercial banks lending to the private sector remained strong at 10.2% in July 2026, compared to a contraction of negative 2.9% in January 2025. The Central Bank's Monetary Policy Committee concluded that the current monetary policy stance, with the central bank rate at 8.75%, was appropriate to ensure inflation expectations remain well anchored and the exchange rate also remains stable. In the domestic foreign exchange market, during the past week, the Kenyan shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.40. Meanwhile, the sterling pound was priced at 174.64 and the euro was valued at 149.56. And on the regional front, one Kenyan shilling was changing hands for 28.78 Ugandan shillings and 20.45 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.35. Despite the ongoing conflict in the Middle East and the subsequent increase in oil prices, the Kenyan shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 70% of ordinary revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves remained broadly unchanged for a grand total of $15.24 billion, which is equivalent to 6.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The recent increase in forex reserves was attributed to two main sources, the first being the receipt of funds for the sale of a 15% stake in Safaricom to Vodacom, and the second is the recent disbursement of $750 million from the World Bank that is aimed at economic and fiscal reforms. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. On diaspora remittances, the inflow of foreign exchange remittances to Kenya totaled to $436 million in July 2026, compared to $375 million in June 2026, which was an increase of 16.2%. This increase reflected higher remittance inflows from key source markets, as the cumulative inflows for the 12 months to July 2026 declined by 1.8% to $4.987 billion, and this is compared to $5.08 billion that was recorded for a corresponding period in 2025. The inflow of remittances remains a key source of foreign exchange earnings and continues to support the balance of payments as well as the domestic foreign exchange market. In the money markets, during the past week, the liquidity situation in the interbank market was sufficient to meet demand for overnight lending and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. Meanwhile, the overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. And according to data from the Central Bank of Kenya, the following are the key short-term money market rates. The latest data shows inflation in July came out at 6.49%. Meanwhile, the benchmark 91-day Treasury bill was stable at 8.77%, and the average lending rate offered by commercial banks was recorded at 14.38%. And the average rate for a bank savings account was offered at 3.32%, which is in contrast to money market funds that are offering returns of between 6% all the way to 10%. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 13th of August, and the central bank received bids totaling to 40.79 billion shillings against an advertised amount of 28 billion shillings, representing a performance rate of about 145%. The central bank accepted 37 billion shillings, and the results of the auction were as follows. The 91-day rate fell by about 1 basis point to close at 8.77%, whilst the 182-day rate remained unchanged at 8.95%, and the 364-day rate rose by 3 basis points to settle at 9.03%. Over the past few weeks, the Treasury yield curve has been stabilizing, with interest rates clustering around the 9% level. However, there is still the possibility of higher interest rates driven by increased government borrowing as the Treasury seeks to plug a budget deficit of about 1.2 trillion shillings for the current fiscal year 2026-2027. In addition to that, the ongoing conflict in the Middle East continues to push up oil prices, and as a result, we can expect inflationary pressures to pick up, and this will eventually feed into higher interest rates as the central bank endeavors to keep inflation expectations well anchored within its target range. As a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the negative impact of inflation. In the primary bond market, the auction for the 3 reopened infrastructure bonds was held on Wednesday, the 12th of August, and the central bank received bids totaling to an outstanding 460 billion shillings against an advertised amount of 150 billion shillings, representing a performance rate of 307%, and the results of the auction were as follows. For the first bond, this was a 16-year bond that was initially issued in 2019 and now has 9.3 years left to maturity. The central bank accepted 112.6 billion shillings at a weighted average rate of 12.19% versus the bond's coupon rate of 11.75%. And for the second bond, this was an 18-year bond that was initially issued in 2021 and now has 12.7 years left to maturity. The central bank accepted 105.5 billion shillings at a weighted average rate of 12.68% compared to the bond's coupon rate of 12.66%. And for the third bond, this is a 21-year bond that was initially issued in 2021 and now has 16.2 years left to maturity. The central bank accepted 93.8 billion shillings at a weighted average rate of 13.05% compared to the bond's coupon rate at 12.73%. Please note that the interest earned on infrastructure bonds is exempt from withholding tax. At the Nairobi Securities Exchange, Kenya's first domestic exchange-traded fund based on domestic assets is set to debut on the Nairobi Securities Exchange after receiving regulatory approval. This ETF will provide investors with a diversified exposure to the banking sector that is valued at about 1.64 trillion shillings in assets and is backed by 287.7 billion shillings in combined profits for 2025. The Capital Markets Authority has given approval for the listing of the WSA Banking Index ETF on the Nairobi Securities Exchange, making it the third ETF on the exchange after the Absa New Gold ETF and the Satrix MSCI World Feeder ETF, but the first to be locally domiciled. This ETF is issued by Wall Street Africa Group in partnership with Tradium Asset Managers and is expected to list on the NSE's main investor market segment in the fourth quarter of 2026, subject to completion of pending listing and operational requirements. The ETF will be structured as an open-ended scheme and seeks to replicate the NSE's banking index by investing in its constituent banking shares and allowing investors to gain diversified exposure to the sector through a single exchange-traded security. The CMA's chief executive, Wycliffe Shamir, said the product aligns with the regulator's push to facilitate innovative investment products, broaden diversification opportunities, and deepen the capital markets. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as of June 2026 stood at 13.01 trillion shillings, and this was divided between domestic debt, which stood at 7.32 trillion shillings, and foreign external debt that is valued at $43.90 billion, which is equivalent to 5.68 trillion shillings. According to the budget for the financial year 2026-2027, about 48% of total expenditure, which is equivalent to 2.3 trillion shillings, has been designated for public debt servicing. Essentially, that means that about 50% of the total budget is going directly towards debt repayment, tightening the fiscal space available for development and economic growth. A recent debt sustainability analysis described Kenya's debt as manageable, but also highlighted a high risk of debt distress. Kenya's current debt to GDP ratio is estimated about 70% of the country's gross domestic product, and this is in breach of the country's debt anchor that is set at 55% of GDP. Up next is our topical issue. And this week, we are looking at Kenya's borrowing to finance debt and recurrent expenditure. The Treasury borrowed over 207 billion shillings to pay salaries, debt repayments, and other recurrent expenditure in the financial year ended June 2026. This is in breach of the Public Finance Management Law, where Section 15(2)(c) of the Public Finance Management Act 2012 requires that national government borrowing should, over the medium term, be used only for development and not recurrent expenditure. The draft 2026 Budget Review and Outlook paper shows that the government borrowed 983 billion shillings in the financial year 2025-2026. The Treasury, however, says that only 776 billion shillings was spent on development, leaving 207 billion shillings to fund recurrent expenditure. This disclosure means that more than 1 in every 5 shillings borrowed in the financial year to June 2026 did not go into development expenditure, but was instead used to finance the ordinary cost of running the government. Kenya faces severe fiscal pressures and cash constraints driven by high debt servicing costs and below target revenue performance, prompting the Treasury to tap loans for recurrent spending. The Treasury's figures shows that about 79% of borrowing financed development expenditure, whilst 21% financed recurrent expenditure, highlighting the gap between Kenya's legal borrowing rules and the actual budget financing. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them posted on the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, life is like riding a bicycle. To keep your balance, you must keep moving. A quote by Albert Einstein. Think about it. Thank you, and God bless.